quick video here on the NakedDelta Matrix and how to use them, how to read them, and what all the little different instrument filters mean, where they're operating. So the first thing is the naming and the market cap, and we can look through which sector it's in, which industry group it's in, which index it's in, and then its ticker name. Then we have a search bar which allows us to change the number of DTEs. It can be done, it's relating to this matrix here, but it could also be done down here. Again, we have a similar sort of filter in our main filter legend. In the filter legend here, we can, if we want to have a look at how something's going to play out, we can use this duplicating the row or removing a duplicating row. And it's just a little simple system of clicking forward, so we can then see if we had a big change today, what that change is going to look like after 3 or 6 days to see how it holds. It's just a good way of projecting forward. It's not a definite thing that's going to happen, but it gives you a better idea of weight, because colour as a very fast way to interpret is much stronger when you're looking at a larger block of it. So if we just go through, I can just quickly remove those. If we just go through the next 2 little buttons, the Delta sorted matrix. So if I click on the Delta sorted matrix, it's this little matrix. It starts with a view of 10 columns in its matrix, and it can be put up to 30 columns, and it can go for anything in between. So it can have a lot of columns, and what it's actually doing is showing to you how that open interest is moving around at the money, because things, their deltas aren't going to stay in a straight line in the column as they might when we're looking at a straight up and down matrix. It gives you a good idea of how things are moving between the deltas. Up the top, we've got a little delta range, so we can see that, you know, as this has gone, the price of this has risen. It's gone flat here. It's staying in the same delta range, but as it was rising from being in the peak 0.37, the price was rising. It moved into the 0.47. So you can see basically how the option group that you might be looking at, and I look at them as groups rather than strikes. I look at them as deltas rather than prices. Because of the way they move, I don't specifically look at them in a strike value. All of these can be filtered, and we can filter both in here, or we can filter in the straight matrix, where they are delineated by strike, and they are forced into a position where, or they are massaged into a position that we can see through. So the different things we can change is the number of delta divisions. We can have it as a gamma. We can look at that gamma, and that tells you what the value of gamma is, the GEX, the gamma of open interest is of that group. So we were looking at about 25,000 options here. They're in the 0.43 to 0.47 delta range, and so we can see that they're sitting at about 12, I think it was 27,000, they're sitting at about 12,600 GEX. So if the underlying moved $1, this option would have changed in price in this range of 0.47 to 0.43. So that block of 27 would have changed in value by 12,000. Sorry, from 8,000, that would have changed by 4,000. So excuse my little error there. We can also look at it as how the IV moves across the different deltas and how it is affected by those movements. Easiest way I look at things is I like delta, so I'm going to go back to looking at how many actual options there were in those positions, and we can see here that there's been a reduction, and that they've kept in a straight line. So if I went and looked at lemonade, I would see that the price has probably been fairly static for a little while, and here we go. We can just look across. It's gone up and down a little bit, but pretty much it's gone straight across. And so it has sat, these have sat in that area, and they've changed here. It's gone down by 6,000 on Thursday, and Friday it's gone up by 91. The other little button next to it is the 30-column NDM. So it's the same NakedDelta matrix as this matrix here, which is 15. but it's for 30, and it's the best way to look at the finer details, especially in small ranges of expiry dates. Now, we don't look at contracts just in one expiry date, because the one expiry date is a little bit irrelevant to how the gamma changes and how the theta changes as you are coming towards expiry. It changes at different rates. So we look at them as a larger group in knowing that the 30 to 45 day gamma range is about the same. When we get below 30, we know that people are risking a lot of money on a short trade, so they're much more confident of that trade value, or they're much more stupid about that trade value, but they are confident in what they're doing. And we find that a lot of the traders who know their stuff are happy to trade in these ranges. In all of these, we can filter all of them down here in deltas, and we can also filter that DTE range. So this is 0 to 1 days to expiry, and we can range them the whole way to, as this one is, which is all DTE. So that is showing you all options which are fitted within the NakedDelta matrix here. The very basic thing on both this chart and on the 15 chart that we were looking at a moment ago is the green is the calls and the red is the puts. The first line is the change from yesterday to today. So blue is a minus or a closing of one of the options that was open in that column, and orange is opening of new contracts into that column. And then down the center, we have a put-call ratio, and it gives us the total number of puts and calls on any given day. So we can see here it's building as we rise, this price is staying up here in the flat, and we can see that a lot of that building is happening here out of the money. Now, to see that in different ways, we can quickly chuck in a 0.5 filter, and that'll give us the at the money and below. So here we go, at the money and a higher delta, so more in the moneyness. We can see this is the number of options that are in the money, and down here it gives us the total number of options that are in the money. And then disappearing out of range is the out of money. So if we look out of the money options, we can see here that in 0.5, so at the money through to 0 delta, we have a range that is slowly decreasing as it goes up. Another interesting fact that we can see there's quite a large increase in the last couple of days here. So people look like they could be selling some calls because they realise that they're at the top, and they also could be doing some hedging. Let's just go back and look at the different options when we are looking. Oh, I've gone a little bit too far there. So when I'm looking at this data, I like looking at it in two ways, and in one way in this set of data, I do change it a little bit. As we go in and out of close to an OPEX, I change the filters a little bit to capture more of the deltas within the range that might have a large gamma effect. So down here in the 0 to 30, we have the block of the largest open interest, which is affected the most quickly by gamma, so moving around at the money. And that means that these are the options that affect the market makers and dealers the most. It affects their need to hedge or flatten their deltas on their books, because they don't want to risk, they don't want to take the other side of your trade. They just want to stay flat for the other side of your trade, knowing that 80% of all options close out of the money and worthless. So a couple of things we can notice here is that we've got a large number of options opening out of the money in calls. That is quite a defensive thing to do, as well as we have quite a large number of options closing in the money. Again, that is negative. That is profit taking. This is so that's closing in the money calls. This most likely here is opening, selling to open out of the money calls as a reversal is expected. And if we have a look here, we've got an increase in the high delta puts. Actually, we've got an increase in all puts here, but we've got an increase in high delta puts. a big enough increase that there's some expectation that something might be happening with this stock in the near future, which they want to hedge against risk. So if we're going to have a look at it, on Wednesday, the 5th of November coming up, we have an option expiry. And so a lot of traders have decided, let's just close down, a lot of traders have decided that it is now, they've decided in the last 3 days, because of the changes in IV, and if we have a quick look at it, we can probably see that IV has got more expensive. So here we can see we've gone from Fridays wasn't too expensive, but we've gone from a day where the IV was in the 300 range, and it's gone up to double that by the Thursday. Into the Friday, it's about 1 1/3 times that, but still quite expensive compared to how it was. That might be some relaxing here of what the market maker was initially thinking. So if we went and we had a quick look, what do I mean relaxing? He wasn't having to reach so hard, which here, if we have a quick look, and the IV here is the purple line, he is reaching quite hard. So that is a little bit of an anomaly, and I would think about why they're going so hard. So some people have been driven by IV to buy in early, and some people have been driven by just the time. They don't want to hold the position for so long, so they've gone deeper into the money and they're holding it for a shorter period of time. So this area here is the highest confidence positioning that we see, and it's the easiest to read. It doesn't give us the long-term positioning, it gives us the short-term positioning. So it's the positioning is from 0 days through to 30 days, and this is where I hunt for most of my information to see what short-term moves are for swing trading. The next filter is pretty obvious to you. It's just, it has, a little calendar you can pull down. You can move it in years and pick out a particular month that you want to do. So if you're looking for a particular trade range to see something that might be analogous from a previous year, you can go back and have a look and see how that played out. The next one down we had a quick look at, and that was the deltas and being able to filter by delta. So we can see that this is my favorite filter range because it really splits up how I think people are trading. And in the money are the strongest trades, and the out of the money are the defensive trades. We often get an out of the money trade when we get a bottom in puts, and that is because people sell puts as they think that something is bottoming away. We see it a lot in the bonds. We see it's a favorite trade of the bonds. They're getting that much higher smile or the much higher value of the IV smile in the puts than they would if they were buying the calls. But also they're getting, as you come off the bottom, they're gaining a bigger decline in the intrinsic value of the option as they trade away from that bottom. Where here, as they trade up into, when they go long a call and the price rises, they suffer from vaguer destruction as the volatility drops and the pricing part of the algorithm of the option pricing drops, and that you lose value. So a lot of the time off a hard bottom, you might want to go with a leveraged stock owned rather than a straight option owned, or you might want to go with a call spread. So you might have quite a close call spread off the bottom. So the long part being more in the money is losing a little bit more, but not a great deal more than the sold slightly further out of the money call. And that you wouldn't suffer Vega so much. And because we know of the way people trade, we can make assumptions about where this positioning is happening and why it's happening. And so we have to have some sort of basic knowledge of how we think traders are going to position themselves using options. And so it's quite important to know the classical trades of option traders. The other thing that we notice about these option trades, they are becoming more prevalent within the option trading world, but they're definitely option trades of well-trained older option traders rather than younger option traders. They give you the most reward for your risk, this style of trading. And the advantage of giving you a bigger reward for your risk is that if you repeat this many times over a period of a year, those nickels and dimes add up and give you a higher alpha or a higher profit margin for the year. The next thing that we know is that people go into positions, into long positions from the bottom of positioning, and they take out long DTE hedges when they're expecting a longer pullback. And so when we're looking at these pullbacks, we can ascertain some things about how long we are into a pullback, because often these long delta hedges, they're not actually removed until the price attains the price that they were bought at. There isn't a lot of theta burn in them because they're buying options here over 250 days, so over a trading year. So then they're not losing a lot of their intrinsic value. So they're happy to hold them till they know that they're back in the money. I did start by saying that I was going to look at the TV chart. So let's just have a quick look at the TV chart. There's several things that I've got crossed off here on the TV chart, little instrument board. I don't have the call gamma or the put gamma in. I don't have the lower than 30-day IV. I have the 31 to 60-day IV, which I quite like as a medium level of IV. I don't have the liquidity buy indicator on, which is different to the ND buy indicator. It's showing us when we've got very high very tight liquidity compared to or in a ratio to the other things that we know suggests that there is purchasing going on. So it's triggering a buy signal. And if I wanted to just click it in, it comes in. It is fairly similar because it is using some of the same data inputs, but it's not using all of the same data inputs. The next line here is this, as we were just looking through them, is this little purple line here, IV 60, 31 to 60. And that's my favourite. Obviously, it goes up when price dips or when price is being squeezed. And these are times when market makers are finding it hard to buy the underlying, and so they charge more in their IV if you own an option or you want to own an option. And so the characteristics are dipping price, or when a market maker is getting squeezed, he's having to buy it. He's having to reach to that ask to buy. The top line here is DPI, Dark Pool Index, or Dark Pool Interest. It is a simple little equation. We look at the over-the-counter trades, OTC trades, which are reported at the end of each day's trading to FINRA, which is part of the Securities Commission, the SEC, and it tells us the total volume and the total number of short sales. If you're short selling and you're a dealer or a market maker, someone within the SEC the Security Commission wants to check that you're not selling more than the short float, because they do not want tickers or stocks or companies having too much shorting done to them, trying to drive their price down and actively working against the company. So FINRA control that, and what they do is they provide data at a commercial standard to people. They collate it from all the different indexes and platforms that supply liquidity. They put it all together, and then we do a little simple mathematical equation to work out whether something is being bought or it's being sold. And it's one of the only places we can see where something's being bought or sold. So we can see here with a price dropping and the DPI going up that we can expect that that's accumulation. If we have DPI going up at the same time the price is going up, we can consider that that is just hedging for the price increase. The market maker is having to go and buy the underlying to keep his book flat. So he's buying it as the price goes up. We can see it here. This is rising at the same time that the price is rising. And here we're starting to see the price dropping at the same time. Sorry, the price is dropping at the same time DPI is dropping. So again, people are staying long. They're staying in their position, but they're holding hedging. So the market maker is having to sell. So we see it dropping again. It's a very good way to look at building periods. We can see we get these lovely building periods where we get this sort of convex lens effect with DPI over the top, and underneath we have these. Just turn some of these off out of the way so we can see what we're doing. We can see we get this lovely effect of rising DPI and low price. And so we can see there's accumulation happening here. We rarely see in these stocks when we might see a little bit of a very high shot up here, just in this little corner here at this top of this peak. Might be a little bit of one there, where we see we've got a bit of topping DPI there, where our market maker's been squeezed and forced to sell into the peak because of IV and the structure of options of who was long, whether they were long a call or they were short and out of the money call. Whatever it was, I'm not going to go into the different nuances that IV forces the market maker to do, but this is what I call toppy DPI. Here's another bit of toppy DPI, where this bit before and this little high bit before here may well be a market maker offering liquidity to a smaller market maker or a smaller dealer. So there's a couple of things that we can see here that add to the way that we look at the markets. We can see this DPI that's bulging here through a dip, it's accumulation. That is going to give us some impetus. That takes a while to wash through in liquidity. If we go down and we have a look at what we would consider the positioning, again, I put in the 0.5 filter to have a look at that. Don't quite be so skewed by the way this is looking. Just have a look at we've got to remember that it is moving across. This bulk of options, open contract is moving across. This is where I'd be looking in here, the call totals. And the call total is very high in the money. It's growing in the money as the price increases. If it's static and it's continuing to grow, and that put call ratio is changing, and the price is static at the time, we can see that an aggressive position is being formed. Like we saw the other day in Beyond or ASST, we saw incredibly aggressive accumulation of calls when the price was relatively flat. Here we can see we've got about 15,000 put options in the money, and that slowly declined down to sort of 2,000. And that is done by two things: that if there isn't a great deal of delta hedging or re-hedging, that those in the money puts are just falling out of the money, and so they're not appearing in the measure of the delta. And this would give me in the range of at the money or above to be in the money. This gives me a good idea that this stock is still in an expanding phase. It's still increasing because I can see it's going steadily from 15,000. It's dropped down into that 3,000 mark. The other interesting things that I don't use a lot, I used to use them a lot more, is the put gamma and the call gamma. Now, these are pretty obvious that they're going to increase. Here I've got puts on here. I'll take DPI off just so we have a clearer thing to look at. These increase, the puts increase as the price drops. Interestingly, sometimes we see a spike when the price hasn't dropped a lot. It has actually dropped a lot. There was quite a large bump there. But it's interesting to see how they interact if we have the calls and the put gamma up at the same time, and we put them in a range. So at the moment, the range is all, and we could go up here and we could change those to just the 30 days. So we'll see what that does. If I go back and put them in, it changes their makeup greatly. We can see that in this period, when it was rising before it dropped, there was a lot of options open in that 0 to 30 day, and then they dropped off very quickly. That is very bearish to see that many short-dated options drop off. That happened on the 23rd of September. If we went and just quickly reset this, so we had the 23rd of September in, we'll see that drop off. We would also see it if we were looking at the gamma. So we can see this drop off here on the 22nd of September. We've had a huge roll. It's closed. Interestingly, it's dropped here, and we've had a lot of them close in the money calls. But if we go across and we have a look, we didn't actually see for another 2 days later a great deal of the in the money puts closed. And so those traders have picked up. They've probably closed here. They were open the first couple of days down before closing out on the 26th. And even these here, they closed out on the 23rd. And if we go and have a look at that, the 23rd, they were open there, and the next day they were shut. Let me just check that again. That is the 23rd. They're still open there. So they're open on the 23rd, and they've closed sometime during that day. So these are people short in the market. They've taken the fat out of this trade and then they've closed it. And so this is a very good hint when we see a big change in the gamma of the calls at a specific time. It's a good idea to see that it's a top. And we may well see the opposite in a large drop very quickly in the puts, means that we've come off a declining time. Here we've had this put gamma, it's held onto there. The price is now flat, and all of a sudden it's dropped. We can be pretty certain that was the near bottom. People have used the risk. It's increased the price of their put options, and then they've taken them off. So it is a very handy tool to be able to split and see how people are using these high risk relative to the price, as opposed to relative to the other options within that trade. So that's my basic starting video. I hope it's not too long. I will do a better one. I've done this without script. I really should do it with script so it has more continuity. I hope it's helped you understand how the matrix works to a certain degree and a couple of the tools. And I will open this up again later in the week, and let's try and do a Q&A day that any of you can join in and ask me questions about how it works. I'll also do it bit by bit, and I'll explain more why we look at certain deltas in the trading and why there's higher value in those in deciding changes. Anyway, I hope this helps your use of the NakedDelta Matrix, and I look forward to speaking to you during the trading week. Thank you very much.